Bismillahirrahmanirrahim. This is the first video on target costing, and in this video we will learn how to compute a target cost, when the market sets the product price. Now, when the selling price is determined by market forces, the company works backward by subtracting the desired profit from the market price, and this gives us the target cost, which tells the company the maximum cost allowed to stay competitive and still earn profit. Let us talk about uh, pricing goods for external sales. Now, pricing depends upon several factors like the company objectives, the competitive and the economic environment, the customer's demand, and the cost considerations. So, no matter what factors influence the decision, the price must always cover the full cost of the product or services and provide a reasonable profit for the business. Now, the price of goods or services is influenced by many factors. A company must understand the market forces around it. When products are similar to competitors, the company becomes a price taker and prices are determined by supply and demand. However, when products are unique or clearly differentiated, the company can act as a price maker and set its own prices. In target costing, the laws of supply and demand play a major role in determining the selling price. Companies cannot simply add a markup like in cost plus pricing. Instead, the market sets the price. To earn a profit, businesses must work backward from the market price and focus on controlling their costs. They establish a target cost, which is the maximum allowable cost that still allows them to achieve their desired profit. Now, if the current cost is higher than the target cost, the company must redesign the product, improve processes, or eliminate waste to meet that target. This approach ensures competitiveness and maintaining profitability. In target costing, the process begins with identifying the specific market niche where the company wants to compete. Next, the company conducts thorough market research to determine the target price, the price that will attract the desired consumers while keeping the product competitive. Once the target price is known, the company sets a desired profit and subtracts it to determine the target cost. And finally, a cross functional team is formed to design and develop the product in a way that meets the target cost, the target price, and the company's strategic goals. Let us look into an example. Fine Line Phones is considering introducing a fashion cover for its phones. Market research indicates that 200,000 units can be sold if the price is no more than 20. If Fine Line decides to produce the covers, it will need to invest 1 million in new production equipment. Fine Line requires a minimum rate of return of 25% on all investments. So we have to determine the target cost per unit for the cover. Now, the desired profit for this product line, if you can remember, first of all, that the target cost is equal to market price minus the desired profit, and the minimum rate of return is the company's desired profit. So, the desired profit for this new product is going to be the amount of investment, that is 1 million, times the minimum rate of return, that is, or the desired profit of 25%, that is equal to 250,000. Now, each fashion cover will give you a profit of, so we have the total profit of 250,000 and divided by the number of units over there, that is 200,000, that is equal to 1.25. So the market price is 20, the desired profit is 1.25, and the target cost per unit will be 18.75 per unit. Let us look into another exercise. Air Corporation produces air purifiers. The following per unit cost information is available. We have direct material, direct labor, variable manufacturing overhead, variable selling and administrative expenses, fixed selling and administrative expenses, fixed manufacturing overhead. So using a 45% markup percentage on total per unit cost and assuming 10,000 units, compute the target selling price. So the direct material is given to us as 16. We have direct labor of 18. The variable manufacturing overhead is 11. Variable selling and administrative expenses are 6. Now coming to the fixed selling and administrative expenses, it is 50,000 and the total number of units is 10,000. So the fixed and selling administrative expenses per unit will be 50,000 divided by 10,000, that is equal to 5. And the fixed manufacturing overhead will be 150 divided by 10,000 units, that is equal to 15. So the total manufacturing unit cost is going to be 71. So the total unit cost is 71, and to this we are going to add the markup. So the total units is total unit cost is 71 times markup percentage, that is 45%. So this is equal to 102.95. Okay. Let us move on to another exercise. Jarlsberg Cheese Company has developed a new cheese slicer called Slim Slicer. The company plans to sell this slicer through its catalog, which it uses monthly. Given market research, Jarlsberg believes that it can charge 20 for the Slim Slicer. Prototypes of the Slim Slicer, however, are costing 22. By using cheaper materials and gaining efficiencies in mass production, Jarlsberg believes it can reduce Slim Slicer's cost substantially. Jarlsberg wishes to earn a return of 30% of the selling price, and we have to compute the target cost for the Slim Slicer. Now we know that the target cost formula, that is target cost is equal to market price minus the desired profit. Now the market price is given to us as 20 and the desired profit is 30% of 20. So 30% of 20 is equal to 6. So the total cost is 20 minus 6, that is equal to 14. Now coming to part B, when is target costing particularly helpful in deciding whether to produce a given product? Now target costing is particularly helpful when a company faces a competitive market. In this case, the price is affected by supply and demand. So no company in that industry can affect price. So therefore, to earn a profit, companies must focus on controlling the cost. Okay, let us look into another example. Gonzalez Corporation needs to set a target price for its newly designed product, Everready. The following data relates to the new product. We have the information over here. We have the fixed and the variable cost. The costs shown above are based on a budgeted volume of 80,000 units produced and sold each year. Gonzalez uses cost plus pricing method to set its target selling price. Now, because some managers prefer absorption cost pricing and others prefer variable cost pricing, the accounting department provides information under both approaches using a markup of 50 on absorption cost and a markup of 70 on variable cost. Okay, so first of all, let us go for the computation of unit manufacturing cost and target selling price. We are going to go for the unit manufacturing cost, and when we say unit manufacturing cost, we are going to take both the fixed cost and the variable cost. Now the direct material is given to us as 20. The direct labor is given to us as 40, Then we have the variable manufacturing overhead, that is equal to 10. Then the fixed manufacturing overhead is 1,200,000 and the total number of units is 80. So the fixed manufacturing overhead is 1,200,000 divided by 80,000. That is going to give us, this will be equal to 15. So the unit manufacturing cost, if we are going to, so the unit manufacturing cost is going to be, it is equal to 85. Now for the markup, they say 50% on absorption costing. So the markup is 50% of 85, and this is equal to 42.5. So the target selling price is equal to, we add up these two, and that is equal to 127.5. Okay, so the markup of 42.5 per unit must cover the selling and administrative expenses, that is both variable and fixed, plus it must provide a desired return on investment. We go to the second part, that is computation of total variable cost and target selling price, and here we are going to simply take the variable cost. So we have the direct material of 20, direct labor of 40, 20, so we have 20 and 40, and then we have the variable manufacturing overhead, that is given to us as 10. Then the variable selling and administrative expenses are given as 5. So don't forget, here we are going to take the variable costs only. So the total is 75, and this is the unit total variable cost. Now 75. Now for the markup, they say 70% on variable. So markup 70% on 75, that is equal to 52.5. So the target selling price is equal to, once again, 127.5. Now what is interesting is that the markup of now, it is 52.5. This 52.5 per unit must cover the fixed manufacturing and the fixed selling and administrative cost, plus provide a desired return on investment. So this completes the first video on target costing. And if you found this session useful, please like, subscribe, and share the channel, and hit the notification bell button so you don't miss future videos. For webinar or guest speaker invitations, you can contact me at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or suggestions, please leave them in the comments or email me, and inshallah I will reply you back. Thank you so much and happy learning.